A DCF model is like a telescope pointed at the future. It looks precise. The math is rigorous. The output has decimal points, but the image it shows you is entirely a function of where you point it and how you calibrate it. Point it in the right direction with the right assumptions, and it will confirm any business decision that you've already made. But that's not analysis. That is an expensive alibi. Today, we expose the DCF for what it is, the most mathematically sophisticated tool for dressed up guessing in the history of finance. Hello, my name is Todd Hagopian, the original Stagnation Assassin, the author of The Unfair Advantage Weaponizing the Hypomanic Toolbox. And today, on the Stagnation Assassin MBA, we're cracking open discounted cash flow analysis. I'm going to tell you what they teach you in the business school program, what they leave out, and what you actually need to know if you're running a real business in the real world. DCF, discounted cash flow, is the gold standard of valuation, and it is the favorite tool of almost every analyst who wants to tell their boss exactly what they want to hear. Understanding how it works is table stakes. Understanding how it gets manipulated is survival in the real business world. Let's talk about the textbook version. Here is what the textbook says. And to be fair, as always, the textbook is not wrong. It just needs an operator's viewpoint. Discounted cash flow analysis is the most theoretically rigorous valuation method available. It was formalized by John Burr Williams in The Theory of Investment Value in, get this, 1938, and it remains the foundation of corporate finance valuation. The logic is pretty straightforward and correct. The value of any asset is the present value of all of the cash flows that it will generate over its remaining life. Discounted cash flow applies this principle by projecting future cash flows, typically free cash flow to the firm, discounting them back to the present value using a discount rate, which is usually the weighted average cost of capital, and then summing the results. The result is the intrinsic value of the business. The discount rate captures two things: time value of money and the risk of the projected cash flows. Higher risk should mean a higher discount rate and thus a lower present value. This is theoretically correct and practically important. Damodaran is a NYU. He is the master practitioner of discounted cash flow. He has taught it to generations of analysts and produced some of the most rigorous public DCF work available. The framework deserves the intellectual respect that it receives. But let's talk about the real world debrief. Where does it actually hold as a strong framework? DCF earns its tuition in situations where you need a theoretically defensible long range valuation and you have reasonable confidence in your cash flow projections. For capital investment decisions and stable, predictable businesses, infrastructure projects, regulated utilities, long term manufacturing investments with contracted revenue, DCF provides the most accurate value estimate available. When the cash flow projections are anchored to real contracts or demonstrated historical patterns, the model's output is genuinely informative. I've also used DCF effectively as a sensitivity analysis tool when evaluating a potential acquisition, running multiple DCF scenarios, base case downside, stress case, with explicit assumption variation gives decision makers a range of defensible outcomes rather than a single point estimate. Used this way, DCF is the 80-20 matrix applied to value. It forces you to identify the two or three assumptions that drive 80% of the value, which is exactly where you should spend your due diligence energy. A good DCF doesn't give you the answers. It shows you which assumptions are carrying all of the weight. But let's look at the operating room. Where does the DCF framework break down? Here's where the professor sits down and us operators stand up. DCF has 3 structural vulnerabilities that make it the most dangerous tool in corporate finance when it's misused. Vulnerability 1, terminal value dominates the output. In a typical DCF with a 5-year projection period, 70 to 80% of the total calculated value comes from the terminal value, the value of all cash flows beyond year 5. Terminal value is calculated using a terminal growth rate and the discount rate. These 2 small numbers, often estimated with almost no empirical basis, determine the majority of the valuation in your DCF. Changing the terminal growth rate from 2% to 3% can swing a $500 million valuation by over $150 million in certain instances. The most important number in a DCF is the one that represents everything you can't possibly know. That's not valuation, that's structured speculation. Vulnerability number 2. The discount rate is a choice, not a calculation. WACC, the discount rate that most use in corporate DCFs, requires estimates at the cost of equity, which itself requires a beta estimate, a market risk premium, a risk-free rate, the cost of debt, and the capital structure weights. Every single input is a judgment call. Small changes in your WACC equation produce enormous changes in your output. An analyst who wants to justify a higher valuation simply needs to lower the WACC, and they've got about 5 different ways to do it. Vulnerability number 3. The cash flow projections are forecasts. 5 years of cash flow projections are not facts. We're almost never right. They are modeled beliefs about the future based on assumptions about revenue growth, margin expansion, working capital behavior, CapEx requirements, future cost savings. In acquisition context, these forecasts are produced by management teams who have a strong interest in making the business look as valuable as possible. This assumption that projected cash flows reflect reality rather than aspiration is where DCF usually meets reality and starts to blink. So let's talk about the operator's upgrade. 4 moves that every operator should make when evaluating a DCF. First, isolate the terminal value. Calculate it separately and ask, does this number make sense as a standalone business valuation? Terminal values often imply business sizes, market positions that don't exist and may never exist. Second, run a reverse DCF. Instead of projecting cash flows forward, ask, what growth rate does the current valuation imply? If the implied growth rate is implausible, given industry dynamics and the company's track record, then the valuation's wrong. Third, stress the WACC. Most corporate DCFs use a single discount rate. Run the model at WACC plus 2 points. If the investment thesis collapses under a modest discount rate increase, then it is not robust, period. Fourth, require a bear case. Any DCF presented without a bear case scenario is an advocacy document, not an analysis. The bear case tests whether the business is viable if things don't go as planned, which is more often than not. Let's talk about the Stagnation Assassin verdict here. We're going to adapt it. DCF is the right framework for long-range cash flow-based valuation, but it should never be used as a precision instrument in contexts where the inputs are highly uncertain. So adapt it. Use DCF as a range of scenarios rather than a point estimate. Always isolate the terminal value for independent scrutiny. And build the reverse DCF to test whether the implied growth story is real. So that's discounted cash flow, the most rigorous valuation tool, and also the easiest to manipulate. For more information on financial intelligence that protects capital and creates value, you're going to want to grab The Unfair Advantage, Weaponizing the Hypomanic Toolbox on Amazon, and follow the Stagnation Assassin Show. Also, check out toddhagopian.com and stagnationassassins.com for the world's largest stagnation database. And remember, run the reverse DCF. If the implied growth is a fairy tale, then the valuation after it is fiction.